Hello and welcome to M&A Access, the official podcast of the Alliance of M&A Advisors. This is Ekaterina Kozlova, and today's session is all about understanding where the market stands and where it's headed. Moderator Graham Fraser provides a data-driven look at deal volume, valuations, interest rates, and sector-specific activity, drawing on both national trends and on-the-ground experience from active deal makers. Let's turn it over to Graham for the latest market intelligence.
We're thrilled that everybody has made it and you've been able to take the time to join us here. We're going to do a market update program that's going to include a little bit of an overview, a few slides with some statistics on market activity, followed by a discussion with our illustrious professional panel here. And so just wanted to start off by having each person introduce themselves as we go through so that you know who we have here. So at any rate, why don't we start with Nick Stone. We're going to do some self-introductions here so everybody knows who we have.
My name is Nick Stone. I'm a partner with Cyprian Partners. I've been with the group for now 18 years. We make minority investments in founder and family-held companies, supporting them through various stages when they need capital, liquidity to buy out absentee shareholders, make acquisitions, but they want a private equity partner. They're just not yet ready to sell control. So we've been doing this for 27 years. We're currently in the process of raising Fund 6, and my office is conveniently a block away. So nice. Very easy to be here.
Thanks for joining us, Nick. Steve?
Yeah, good afternoon, everybody. Pleasure to be here. Steve Faulkner. I'm a vice chairman at JP Morgan Chase. I run our global private business advisory team. We focus exclusively on private business owners, and we help them think about what transition and success means for them. The team is multidisciplinary, but we're not stepping on anybody's toes. We're not acting as their corporate attorneys, accountants, investment bank. We're really trying to help them think about what's going to be most successful for them, the management team, their family.
And David?
Yeah, good afternoon, everyone. I'm David Allebach. I'm managing director on the investment banking team at Janney Montgomery Scott. Janney is a Philadelphia-based, almost 200-year-old full-service wealth management, capital markets, and investment banking firm. On the investment banking side, I have about 100 bankers in 6 offices around the country. I'm part of the Philadelphia contingent with Graham, but we've got a lot of bankers in Atlanta, New York, and Boston as well, as kind of our core offices. And in addition to traditional debt and equity capital markets business, we do a lot of M&A work across 8 distinct industry verticals. I have 2 jobs really at Janney. One is as primarily a business services investment banker. The other is I act as the liaison between Janney's wealth management group, which is about 1,000 financial advisors around the country, and their clients and contacts. And if they've got businesses that are a good fit for investment banking, I'm tasked with finding the right folks on the investment banking team to connect them with.
All right, so to kick it off, I mean, just to get some perspective here, here we are 6 months after the last national AMAA conference. At this point, I think we're about 7 months into the new administration in Washington, which seems a lot longer than that. We only have 41 more months to go, so I guess we'll see how that plays out. But there certainly hasn't been a lack of excitement. The economic world has been generally on pretty much of a roller coaster since April 2nd, Liberation Day, and the M&A markets have not been spared. I think a lot of people thought going into this year that we were going to see a resurgence back to a more normalized M&A market, a more active M&A market, and maybe not back to the heights of the 2021 era, but at least another big step in the right direction in terms of volume and valuation and leverage. And so generally, I mean, I think our marketplace continues to roll with the punches, despite getting hit hard every now and then. I think the lower middle market M&A market is a pretty resilient market. One thing we've noticed, and I'm going to put some statistics up in a minute, but there has been a focus on, in the lower middle market M&A, Larger transactions tend to be getting closed more with better valuations. And then there's also been a tremendous amount of add-on activity. That's been a real theme for private equity as well in the last year or two, and also in the last 3 to 6 months. I think, had been in a period here where private equity exit activity was at a record length of time. I think we were up to like 6.7-year average hold period for private equity portfolio companies across the board, which is a record. It was all-time high. But in Q1, there was an uptick in private equity exit activity. Continuation vehicles are coming into play. The IPO market opened up a little bit. So there's some better activity there, and I think that's foreshadowing some positive news. And overall, the economy's functioning quite well, despite all the turmoil. And although the M&A bonanza that we've been hoping for this year hasn't really materialized yet, we're going to talk about it, and I think hopefully things are improving. The unknowns still include whether we're going to enter a period of inflation or stagflation, what's the direction of interest rates. There's a lot of geopolitical unrest. Another good news point, the CPI inflation number was printed this morning, and it was 2.7%, 2.3 core. So inflation's still low. It hasn't jumped up, which is great. And the stock market keeps hitting new highs. So, I think there's a lot of positive. There's a lot of opportunity amid the chaos. But overall, we're seeing a market that's not as robust as we'd like. To go back and just look at some statistics, this is GF data material. The bottom line is that in Q1 of 2025, which is the latest report for which there is data, the volume was down significantly. It was down about 40% from the Q4 data. And you can see here, if we go to the quarterly numbers, that there were 59 deals posted in the quarter, and there's like around 400 private equity sponsors that contribute data to that system. That's down from 98 deals in Q4 2024. So that volume was down significantly in Q1 for a lot of reasons. Political and economic uncertainty really ruled the day. But the multiples were healthy. The multiples were up. The multiples on average at 7.6 times for Q1 2025 were actually versus 7.3 times average multiple for Q4 2024. It was actually the highest average multiple since mid-2022. So, viewing that really as, okay, fewer deals are getting done, but the deals that are getting done at healthy multiples. So you've got kind of a flight to quality going on. A lot of the deals that aren't getting done and contributing to the lower volume numbers are really deals that are taking longer. They're suffering a lot of scrutiny and diligence, and some of these deals just aren't getting done. I know for us, at my firm, Private Capital Research, PCR Partners, we've had a couple deals fall apart. We've gotten one closed recently, but it is, we do buy-side M&A, and it is not an easy world out there to get deals closed. Bigger deals do seem to get more momentum and maybe they've got better reporting, deeper management teams, et cetera, and they can start to, they can make it through the process. So the bigger deal tiers showing higher multiples, higher quality targets are getting premium multiples right now. I know in the deals that we're looking at PCR, we're getting outbid on a lot of companies that have very, very nice metrics. And it's kind of scary what's happening with multiples overall.
Yeah, so anytime I do one of these panels, I try to share something that might not be a glaring glimpse of the obvious, right? All of you work in the industry, you know what's going on. So a couple of the data points here, those that are very common to what we see on a day-to-day basis. What we did was we tried to layer that over our internal deal flow since 2017. Because when I was an investment banker, and I think about the time that we're currently in with the interest rate impact on valuations, the valuation impact on sellers' willingness to trade, it generally results in weaker deal flow, which means lesser fees for our investment bankers and service providers and many of us that are here attending this conference. And when I was in investment banking from 2002 to 2004, it was also a pretty weak period. Non-controlled deal flow, these owners, founder, owner, and family-held businesses that are looking to raise capital to buy out absentee shareholders or make acquisitions, that capital need is idiosyncratic with the general M&A market, as evidenced by our pure-play non-controlled deal flow. And I know many of you in the audience historically have not worked on non-controlled deals. I'm not sharing this with you as to be selfish or pound our own internal drum, but there's a way for you to make fees off of those. And there are some licensing restrictions. I don't want to be completely tone deaf as I'm talking to this group, but there's multiple ways. Can I say skin the cat anymore? Is that inappropriate? Okay. There's multiple ways to skin the cat. Yeah, you said it twice now. And so, I encourage you to think about those as a way to monetize it in the absence of, or perhaps in the midst of a rough M&A period.
Yeah, we have a client that we're working with that does non-control, minority equity and structured equity deals, and it's some interesting targets these days. To just touch on leverage statistics, it's been, generally speaking, pretty steady. In Q1, total debt numbers were 3.3 times EBITDA in the capital structure versus 3.7 times in Q4 2024. The $100 to $250 million enterprise value segment showed a steady trend of increased leverage. Again, bigger deals attracting better leverage. Smaller deals, kind of mixed results, but generally speaking, that's been steady for both total debt, and this is senior debt here. So obviously smaller numbers, the difference would be the mezzanine portion of the capital structure, subordinated debt. So no big news there. Some news on debt pricing that has allowed for more senior debt to come into the capital structure. And it shows the lower line is senior debt pricing, and we all know how that went up about 500 basis points and then has subsequently come back down. But one of the things about this slide that I always find interesting is the resilience of subordinated debt coupon. There's other bells and whistles with subordinated debt, as you know, that enhance or retract from total return for sub-debt players. But the coupon remains incredibly steady around high 11s or 12% in that category, which is really remarkable. You can see as we got into the first quarter of 2025, a little more senior debt coming into the capital structure. Rates came down a little bit. There's a little more openness to that, a little bit less equity going to the capital structure, and more sub-debt coming in too. So a little more structure. But that's, to give you a good idea on how things are going in terms of capital structure. Start with Steve and talk about how you're seeing the M&A market in light of some of these statistics and what the word is from your camp.
Yeah, I mean, I agree, right? There was a lot of optimism coming out of the election last fall, and since then it's been pretty turbulent. For us, it's been a incredible opportunity for engagement with business owners, and so and I'll start with this. This is kind of the obligatory. I mean, these are my statements, my opinions, not those of my employer. But we've spoken with about 3,000 business owners this year. Engagement is up 36% year over year.
When you say engagement, you mean
business owners wanting to have those conversations, understand what's happening, what they should be thinking about. And as I introduced myself, we're in the business of helping people think about transition. Today, about 20% of our clients want to retain a business multi-generationally, so 80% are looking to monetize in some form or fashion. That's a huge paradigm shift from where we've come since I built this pillar several decades ago. It used to be in the United States, the slight majority of clients that we dealt with, they wanted to retain a business multi-generationally. Now,
Majority wanted to retain.
that's
Okay.
right. Now, their kids may not have wanted to, but they weren't telling mom and dad that. And today, we find ourselves in a very different place, right? The overwhelming majority of our clients are going to monetize. And the ones that aren't, I can tell you which industries those are likely to be in. And then you get this dichotomy among the 80% of what I will call kind of traditional founder, business owner, created, run businesses. They could be Gen 1, they could be Gen 2 or Gen 3. And then on the flip side are the businesses that are more recent, where the cap table is more diffuse. You've got institutional money in there, and those were businesses that were always built to be sold. And so, you know, that's our clientele, and that's who we've been talking to. And I will tell you that I spent more time in Washington, D.C. in the first 3 months than I had in any other entire year trying to read the landscape. And I will also, in all candor, say I came away more confused having spent that time in Washington, D.C. But it gave me an opportunity to talk to business owners around the things that they should be thinking about, the trade associations, how they can voice their concerns around Liberation Day, supply chain disruption, volatility. But you know, the point that I would come back to, and I think this is something for all of us, is business owners today, they need to hear from us more now than ever. And you know, and I would posit that economic dislocation, economic volatility has accelerated exponentially. And so nobody talks about 5-year plans or 10-year plans. I mean, everything's like, you know, what are we doing in 2025? What are we going to do in 2026? And go back to, you know, you had COVID in the last 5 years. We had COVID, incredible disruption globally. We've had the failure of, you know, a handful of significant banking institutions in the United States. You know, you just kind of the litany, it just goes on. We've had disruption in terms of Liberation Day, supply chain, tariffs, you know, inflation. And I think for business owners, it's a very challenging environment. But the message I'm hearing from everybody is just tell me what the rules are. I can make money if I understand what the rules are, but I'm afraid to deploy capital. I'm afraid to any longer term project because I don't know what happens in the mid-year elections. I don't know what happens in terms of the next administration. And that's been the challenge. I think it's also partly the reason why more of our clients today are thinking about monetizing as opposed to trying to retain a business where, you know, the other disruption I didn't really talk about is AI, right? And everybody understands this is going to be hugely disruptive. That disruption may create opportunities, but it's certainly going to create challenges. And are they up to those challenges? Do they have the capital to continue to grow, to build, to create those moats? Or are they better off just monetizing their business? And you know, those are the discussions we're having. I think that as difficult as the messaging has been, the best part of it is I don't have to ask for those meetings. They're asking for those meetings. And I think that's really important, you know, being an honest broker as it relates to what we know, you know, what the known knowns are, the unknown knowns are, and being that advisor.
I think it's true, and it's good news for everybody in this room, too, as well, that is engaged with business owners, knowing that they need the kind of advice that AMA people are providing. David, how about the view from Jani's perspective or from your perspective on how things are going with the market these days?
Yeah, so sitting at this conference 12 months ago, you know, I think everyone was looking forward to 25 being the year we all got back to normalcy and, you know, an increased level of activity. And the last 6 months have really been anything but. But what I would say is we don't have nearly the volume of engagement that Steve and his group does, but I think we have enough volume that we can start to you know, make some observations around it. I looked at our stats across the group before I came out, and we've got 60 active M&A engagements on the sell side, and that means either it's preparing for market, it's in market, or it's under letter of intent and hasn't closed yet. And that's up pretty substantially from where it was a year ago, which, if you had asked me 3 months ago, will we be that active in July, I would have said there's no way, given the uncertainty we've seen. And the majority of those engagements are we're engaged and we're preparing for market, meaning we're putting materials together, we're developing a buyer's list, and it's a deal that intends to launch in the next few weeks. And so I think that tells us something about a return to activity, despite all the uncertainty that we've seen in the market. The other interesting observation I'd make on that is traditionally about half of our business is sponsor-backed exits, and the other half is private or family-held business in the market. Traditionally, that's been half. It's less than a third is sponsor-backed of the active engagements we have. And so, everything that we hear from our friends in private equity and what the market tells us about, a lot of private equity exits sort of sitting on the sidelines right now, we see that in our business for sure. But it has been sort of filled in by the private sellers and the family-held businesses who are ready to do something. And despite all the uncertainty around tariffs and interest rates in the economy, we see people moving off of the indecision and moving forward. I'd say our conversation, or my conversations with business owners that come to us through the wealth management channel, again, not nearly the volume that Steve's group has, but it's all very similar conversations about, we're not necessarily ready to be in market today, but we need to put a plan in place and start understanding what timing looks like and the decision points to move forward in a process.
So we've been talking about the demographic wave for, seems like ever now. I mean, at least a decade. The silver tsunami. Do you think this is, happening now, or if not, what inning are we in? Where are we with that from your viewpoint and Steve's viewpoint? I'd love to hear, because it's such a fact, but it just seems like it has gotten delayed, or it hasn't come at us the way I think a lot of people might have expected it to happen 5 years ago.
Yeah, in any given year, we have, at Janney, we probably have between 100 and 200 referrals from our wealth management channel of business owners who are interested in a conversation. The numbers are up pretty dramatically over the last few months. As Graham said, we've been waiting for this silver tsunami to come for, it feels like 10 years now. And it's always sort of out there, right? All these baby boomers need to sell their businesses. They don't know what to do. They don't have kids to take over. They're all going to have to transact, and we haven't seen it. But this year it feels a little bit different, and we have a lot more conversations now around tactically what does exit planning look like. If you don't necessarily want to transact in the next 6 months, but you want to do something in the next 18 months to 2 years. Tactically, what do you need to be doing today to put yourself in the best position to go through that process if and when you're ready over the next 2 years? And that gives us a great opportunity to engage with those business owners and bring value in partnership with our financial advisors. And so I think, anecdotally, we're starting to see much more activity from that silver tsunami. And it's all within the same general demographic. It's business owners, from their mid-50s to their early 70s who, we've all been through a lot over the last 10 years, and we're all in the middle of a lot right now, but it feels much more tangible today than it has, again, in my experience over the last few years.
Interesting. Steve?
Yeah, I'm going to say we're in the seventh inning stretch. Part of it is just the psychology of a lot of our entrepreneur, founder-owned businesses, which is they may enjoy golf, they may enjoy sailing, they may enjoy, other hobbies, but they love going into the business every day. And so it's that lack of a next identity that keeps them from pulling the trigger. One of the things probably very similar to what David says is we tell them the economy gets a vote too. You don't get to pick the time that you exit your business. And you have to be thinking about it in terms of, are we in an upswing? Are we showing growth in our revenues and our margins? And going into the teeth of an economic downturn, that's a really tough time to pick just because it hits, you're 75 or you're 80 or whatever the age is. So I do think that, a lot of business owners are increasingly cognizant of the impact of the economy on the timing of their exit. They're just struggling a bit with, what's going to replace what I do, who I am. And we're trying to help them. Sometimes it can be just, partial exit through financial sponsor, and they've got an opportunity to roll over. But for us, it's about, education for those business owners and helping them think about what are they really trying to do? Are they trying to optimize value? Because that looks a little different than, staying in the position as long as you can until you're just no longer physically able to do it.
Right. Nick, that kind of plays into some of the work that you guys are doing there as well, giving the business owners options that aren't all the same. So why don't you tell us a little bit about how you guys are seeing things and what that means for business owners in transition now?
Yeah, so back to some of the points that have been made already. These owners and shareholders are talking with their advisors and you in the room about what they should do and what they should be doing and where are valuations. That creates conversations around the dinner table amongst the first and second or second and third generation. At the same time, with private equity sponsors not being able to pay today what they could 2 years ago because of the benefit of financial engineering, now some of these family-held businesses are strategic buyers that are winning processes. And so the families are saying, well, now isn't the right time to sell, but we've got this really interesting add-on acquisition. In order to complete the strategic acquisition, we need to raise capital. Well, Aunt Betty and Uncle Joe, who are in their 70s and 80s, don't want to take the second trip around. They're saying, listen, that's great. You go have fun, but can you cash me out? And so as part of the capital raise to facilitate that acquisition, they're going to the lenders in the room and elsewhere, commercial banks, non-bank lenders. They want to raise 4 or 5 times because that's what they see printed in the headlines. But that's only available to financial buyers. To family-held businesses that don't have the deep pockets, they're not able to raise 4 or 5 times. Their local commercial bank might say, we'll give you 2.25 or 2.5 times, but there'll be a personal guarantee attached. In order to solve the delta, they're calling SBIC funds, credit funds to provide mezzanine, preferred stock, minority equity to fill that gap, not just to make that acquisition, but to go back and buy out Aunt Betty and Uncle Joe's shares as well, or perhaps allow the shareholders to take a dividend, which banks don't want to see anyway, particularly in this economic cycle with their portfolio, the state of their portfolios, other headlines they're seeing, and no alleviation to fixed charge coverage over at least the next 2 or 3 months. So that's where a lot of those groups tend to fill the gap. Thankfully, knock on wood, we've closed 4 platforms in the last 12 months, and our pipeline sits at 50 pages long. However, since Liberation Day, a lot of these owners are distracted by, supply chain issues, or now the second and third derivative of that tariff threat is coming into play because now their suppliers or vendors are having inventory issues or having to reprice. And so there's just a lot of uncertainty. But generally, as you think about what alleviates all this, there is no tax cliff in sight, right? That's been eliminated. And as interest rates drop, valuations will go up, but I don't see that happening meaningfully for at least another 3 to 6 months. So, it's still just day by day, not, how do we plan for 25, 26, 27? What do we do tomorrow? What do we do the day after that?
Right. Interesting, the tax cliff removal it was always a motivator whenever there was a potential for that. It was a motivator to get deals done.
It was great in your slide for 2021, like 500 deals that year.
Exactly. Yeah. That was huge. So, David, in terms of target companies and navigating the landscape, supply chain disruptions, worker shortages, et cetera, How are you advising business owners to navigate the landscape that we've been running in lately, which has been challenging for a lot of companies?
Yeah, those are some big topics. Clearly, they impact different businesses in different ways. The way we've been approaching it is we're always telling the story of a business in the best way possible, but we are taking a step back when we're engaging with a new client and managing expectations of, number one, the work that needs to go into preparing materials and telling that story and backing up our positions with data. And number two, counseling them on, this is what the market's going to tell you. So don't be surprised when we hit the market and, 75% of the buyers we contact drop because of issue ABC. But we're spending a lot more time before we're ever launching a deal talking to some of the buyers we know really well that we know will have an interest in this asset, and understanding like, hey, when we call you with this business, what are you going to say about tariffs or labor shortages or whatever the topic is? And we're finding our processes being much more, I hate the word bespoke, but they're more bespoke and customized around who we think the right parties and the right partners are to talk to, and sort of pre-vetting what their responses are going to be for these types of issues, and managing our clients' expectations that there's no way around it, there's no magic bullet that's going to get us past this topic. We need to understand what our own position is with regard to tariffs, for instance, and do the best we can to back up that story with data and start asking ourselves the questions that we know buyers and investors are going to ask before we even get in market. So deals are getting done. We have two businesses in market now that have not 100% tariff exposure, but they've got significant input costs that are tariff impacted. And we did just that. We spent the time up front to ask the question of ourselves, understand what buyers are going to say, and make sure that we can answer those questions credibly, and just be realistic with our clients around what the market's going to tell us. So if anything, it's more preparation, which can extend a timeline. It's preparing our clients for more diligence. I was telling Graham before we came up here, we just closed a deal that was under letter of intent for, I think, 6 months. Very willing buyer, very willing seller. It just took a long time, every single stage. Ultimately, we got there, got to a great outcome, but we had to slog through it, and that seems to be the case in more and more cases.
And we've definitely seen that too, in terms of the level of scrutiny and quality of everything, and what it takes to get a deal done. And the businesses that we've seen that are of the highest quality or of higher quality are ones that are making it through and getting the deals done. And frankly, they're getting done at very high multiples. We've been, like I said before, our clients have been outbid on a number of deals that are very nice companies, but multiples have just climbed. And overall, multiples have just been on the rise for a long period of time. But then there are all those other businesses, the other 80% or whatever number of them that don't meet that grade, that aren't the best quality metrics. Steve, with the willingness of owners to talk about doing something and planning for an exit, will their businesses will their performance of their businesses be able to support valuations that are going to satisfy an ownership group that might be diverse in terms of a family, or to be able to actually, close that gap?
Yeah, I mean, if we're talking about kind of non-A assets, I think there has to be, a real reckoning around where the valuation's going to be, what the deal structure is going to look like, how you prepare. And a number of those business owners have been the ones that have said, okay, maybe this isn't the right time. Maybe instead we ought to be internally focused on how do we improve to get rid of some of the impediments to getting a deal done. Those are businesses that in a different environment would still be attractive. It's just hard now to get those deals done. And, if you look at those letters of intent, they're very short. They don't have a lot of definition around them, and that's what concerns us once you give up exclusivity. So a lot of candid conversations with business owners in that regard. And then also about kind of what the process should look like to what's most important to them in terms of what a buyer looks like and how do they protect themselves going into that process. So there's a lot of discussion around education with those I don't want to call them troubled assets, but they're just not those A assets that are commanding the valuation premiums that are happening right now. But I am still optimistic. At least I was optimistic until I showed up this morning and started talking to everybody here. I may not be quite as optimistic as I was when I entered the hotel. But I think there's a lot of factors that, if we can just climb that wall of worry, that we're going to see a much more conducive M&A environment, hopefully by the fourth quarter this year, but certainly kind of thinking about 2026. And that's what gives me optimism. And a lot of the business owners, they feel like, well, look, maybe that is the right time to pull the trigger. And I'm seeing a lot of conversations with business owners who are talking about what should I be doing to improve the performance of the business or the optics around the business. How do I begin engaging with sell-side QOV providers? Who should I be thinking about in terms of representing me on the investment banking side? What type of deal and what should I do to lock up key management going into that process? So, I do feel optimistic. Now, we'll see whether the other shoe falls. But, if this were July of 2020, we'd all be going, yeah, this is a horrible environment. And then in August, suddenly just things turn. It was fast. And I'm not suggesting that's what we're going to see in August or September, but I just get this sense that there's a lot of pent-up demand. And I do feel like sellers have more of a kind of appreciation for the value of those B assets, C assets today than they certainly did in 2022 and 2023, when it's just really hard to bridge that gap.
Yeah, but if I can tack onto that, the A and A-plus rated assets are going to trade for significant multiples because of the absence of any real credible deal flow, and private equity sponsors have been dying to put money to work. The problem is those A-minus, B-plus, and C-rated assets aren't going to see a valuation pop until interest rates drop, and this is not a anti-Jay Powell speech. It's just the fact of math. Most private equity sponsors are not going to solve for less than a 15% net IRR, and the only way to help them pay more to get to a 15+% net, and some of you might think that is low, but a lot of GPs are looking at those kinds of numbers at the end of the day, is interest rates, and that's what it's going to take.
Now you know why my optimism isn't the same as when I showed up today.
He's only been sitting next to me for 30 minutes.
That's funny. Well, and there's been a lot of activity with preemptive offers and also bigger buyers profiles moving down market, either portfolio companies of larger private equity groups and otherwise. And when they start looking at these smaller companies trying to see if they can make it through the scrutiny of a process is also a real question. And so, again, all of this points towards the help that business owners need to prepare for when this happens. The larger public buyers preempting, I mean, it all sounds good until you get into diligence, I think. I've been doing first corporate legal practice and now at JP Morgan kind of M&A for 3+ decades. In the last 3 years, I've never seen the volume of publicly traded, both U.S. and foreign exchange traded companies coming and acquiring U.S. assets below $100 million of revenue. We had one not that long ago, $30 million enterprise business. I mean, I would have expected that the diligence cost for the acquirer would routinely be close to $15 to $30 million. But they're coming down. They're taking advantage of the very vacuum that you were talking about, Nick. And so, to me, the really interesting thing is going to be
does that change back, kind of revert back to normal when financial sponsors kind of start doing platform acquisitions and more active on the tuck-in? Or do these publicly traded strategics and non-publicly traded strategics stay active and relevant in that lower middle market space? I think they're going to stay, not to the volume that we've seen, but I think they're going to hang around because they see opportunities to really arbitrage an asset against their PE multiple.
Interesting. Yeah, I think that's true. We should do a quick run through because of it is a market update to talk about the debt markets, and maybe Nick, start with you on this. But just how would you characterize the debt markets today? I mean, clearly rates have come down. The market's changed with a lot of new private credit sources versus just banks. But availability versus pricing, et cetera. How do you see the debt markets today, and where do you see it going in the next 6 months?
Yeah. So since interest rates went up was it the summer of 22 or 21? My dates are kind of fuzzy now at this point. 21?
Is that 22?
22. So then we had SVB and First Republic fall in March, April of 23, and you saw everybody, hit pause and spreads expand and leverage multiples decline. Well, over time, and with the absence of M&A going on, you've seen a lot of these credit funds need to put more money to work, and for private equity sponsors, instead of SOFR plus 650 or 7, now it's closer to SOFR plus 450 to 550, and leverage levels of 5 to 6 times, but that's still a 9 to 10% piece of paper all in. So everyone is needing to put money to work. Banks also don't have deposit problems the way that they did 2 years ago. And so there's a real willingness to put money to work, but at the same time, they are also seeing some rough waters ahead. I don't know if anybody caught this report, but Lincoln International in their Q1 report said that actually it was a May report reflective on Q1, but over the prior 6 months, there was $17 billion in equity value handed to private credit lenders from private equity firms. They tossed them the keys. And the reason for that is interest rates continue to creep up, profitability was declining, and the sponsor could no longer justify equity cures to those portfolio companies. So you're reading a little bit about that. JP Morgan, I think, talks about on Sunday in the Wall Street Journal, Jamie Dimon talked about the potential distress in private credit markets. That's why they're dedicating $50 billion to private credit. Everybody is looking to put money to work, but there is definitely trouble in portfolio land of a lot of private equity funds. So everybody's kind of got their eye on that. And then on top of that, with new deals, in addition to tariff risk, we've seen that E-Verify doesn't completely work anymore. Now you got to look past that and do audits. And so there's just a lot of uncertainty out there that everybody wants to diligence. And to the point that was made earlier, I think by David, it's just diligence is taking longer.
Yeah, David, how are you seeing when companies are going through the process and buyers are trying to structure deals?
Yeah, I mean, I think about it from a sort of more near-term tactical standpoint. Then I agree with everything Nick said about potential trouble ahead. But we haven't seen availability of debt being a limiting factor on getting things done. The capital is out there. We've had multiple lenders available for believe it or not, the smallest, hairiest businesses we've had in market. So
there are alternative lenders even on smaller deals, or banks?
Both, believe it or not. But they've taken a long time. Diligence has been, both on the equity and the debt side, has been extended. It's been deeper. It's been more painful than I can remember, but the deals are getting done. So today, the financing is not the problem. Now, what happens over the next 6 months, who knows, but that hasn't been a challenge for us.
Well, and one thing I would add on, too, is a lot of these private credit funds, they're not paid management fees on committed capital. They're paid management fees on deployed capital. So as their portfolio runs off or has trouble, they want to book new deals into that portfolio. That's every incentive they need to go out and finance your next deal or David's or others. I may be a little cynical that way, but all of them are actively looking to put money to work for even companies as low as 3 to 4 million of EBITDA. And sub that, there's a few SBIC funds out there you can talk to as well.
Thank you. Yeah, we wanted to keep that brief, but it is really, there's still, I think, a lot of portfolio companies of private equity groups that were bought at high multiples in the early, 2021 period that were levered up, and rates did go up, and I think there's a lot of hidden issues there hanging around that we're going to find out about in the future. I can't believe it. We're really running out of time. I would just go right down the panel and just do a prediction for what the horizon is going to look like for 6 months from now, from what you can see in terms of the M&A market. Are we going to be better, worse, and how would we look back at 2025? David?
Well, I was feeling pretty optimistic until I sat next to Steve, and so I'm trying not to change my mind. But I think we'll be better. Based on, I don't know how much of a leading indicator our business is, but I think about the velocity of our M&A practice over the last couple months, and the velocity of conversations we're having with business owners, and I think we'll be in a better spot.
Okay, Steve.
Yeah, no, I think you're picking up the negativity to my left, David. And so, I think we are going to be. I think we're going to be marginally better, and I think 2026 has the promise of being the year we thought maybe 2025 was going to be. Hold me accountable, a year from now.
Nick?
And I might surprise some of you, but I'm also optimistic about 6 months from now. Now, in 2024, when people said that 2025 is going to be different, I didn't see it because of interest rates and inflation and other stuff. But now that when we're on the precipice where inflation seems somewhat under control, depending upon this one-time shift in tariffs, Steve told me earlier that the consumer is healthier than I had anticipated, given a reduction in credit card defaults and other things that they're seeing at the bank. So I am positive about what the next 6 to 12 months holds.
Yeah, I also fall into that camp. I feel like we're going to have, things are going to be better. Stock market hits new highs. I mean, it doesn't necessarily relate directly to M&A, but that's a precursor for 6 months out, I think, typically. There's a lot of things that could happen to go right, and I think there's a lot of opportunity among the chaos that we've seen, and hopefully we've seen the worst of that kind of volatility with tariffs, et cetera. But anyway, we are out of time. Thank you all very much for doing this. Thank everybody for coming.
Thank you to Graham Fraser for delivering such a clear and insightful breakdown of today's M&A landscape. Stay tuned for more summer conference sessions here on M&A Access.